I think I'll go ahead and just open up our agenda, being sensitive to time if folks are gonna trickle in. But I do I just wanna say thank you, everybody, for making time to be a part of our investment update and call today for the Vermont Community Foundation. I'm joined today for this presentation by Mike Miller, our colleagues at Crucial, who advise us on our broader investment pools, and then Lawrence Miller, who's been a special advisor, a senior advisor on mission investments, who helps steward our place-based mission investment portfolio, the Vermont Investments. Before I hand it over to Mike and Lawrence, I do want to just acknowledge a couple of key folks, board of directors who are on our call for the Vermont Community Foundation. I see John Vogel. John's on our board. He currently chairs the Vermont Portfolio Committee, and Tim Briglin chairs our investment committee. Cindy Char's on our board, chairs the nominating committee. Mark Foley is currently stepping up as chair of our board. And Eric Miller was RSVPing. Tammy Newmark is there, serves on our investment committee, a member of our board. And Eric Miller is a new director who is starting on the board in September. He had RSVP'd. I'm not sure if I see him on the call yet, but just to give some context to our governance and our approach to investments, I wanted to recognize the board for a lot of time and energy into helping us think responsibly about managing these resources and the role of philanthropy in Vermont. The call is really designed to make sure our fund holders and partners have a clear eye into our approach to management and the performance of these funds over time and the work we're doing. I do want to just pause for a moment and recognize, as John indicated, the role of the Community Foundation and what Vermont has been experiencing for the second summer in a row. I just think we have re-engaged our flood response and relief fund that we had opened last summer and seen an incredible philanthropic outpouring, and really key to the long-term response, key to the response and support of flood affected Vermont families, farms, and businesses. We re-engaged that fund in July when the first round of floods hit this summer, and we've been actively engaged in fundraising to support flood affected farms, families, and businesses again. It is ongoing and incredibly challenging, and there are some communities that are deeply devastated. I will say that this summer, the flood response, the philanthropic response, has been somewhat slower than last summer, and for perhaps reasons that you can infer. The floods hit differently, they hit different places, they were further afield and more remote, and funders in some cases there are big questions about funding philanthropically to solve problems that are recurring again and again. So we're wrestling with a little bit of that, but we have raised north of $500,000, and we pivoted some resources that we'd raised for long-term mitigation back into emergency response. So we are making grants. There's a press release out today, but I'm not going to get the numbers right. But we're making grants already and have been since mid-July to support flood affected Vermont families. Holly's team, Holly Morehouse, leads our community impact team, is deeply closely coordinating with state, federal, and local disaster relief, really holding the integrated list of information about communities, families who are flood affected, and working closely with on-the-ground partners to make sure resources are getting out and are going to help people get through this mess. But we've got a long work ahead. If anything, just take away the degree to which your partnership as fund holders and for the nonprofits on the phone, both nonprofit fund holders and nonprofit service providers, the work of philanthropy together is what makes it possible for our organization to be able to adapt and respond to the circumstances like this as they arise. So thank you for that partnership. I'll tell one story just about our Vermont portfolio. We had that I think is relevant to this. Plainfield was one of the communities that was deeply affected. Every fund at the Vermont Community Foundation has an allocation to our Vermont Mission Investment portfolio. Lawrence had navigated support for the relocation of the Plainfield Co-op into a different spot downtown that allowed them to grow and be more secure and scale. And we had closed our participation in that last week, and just a a point of vitality for the co-op to be in a position to grow in a community and as a gathering place and as a point of connection in a community that has been deeply flood affected and was looking for a bright spot. So in addition to generating returns that power grant making and distributions to organizations broadly, every fund of the VCF has an allocation to work that is strengthening downtowns and fostering community, building affordable housing, and putting new farmers to conserve lands and driving startup and small businesses across the state. So there's a lot of work that's being done that's worth being proud of and recognizing on this call. So with that, thank you everybody for participating. I'll turn it over to Mike. Mike will do his update from Crucial on our three broader pools. Lawrence will do an update on the Vermont portfolio, and then we'll open it up for some questions, if that sounds good. All right, Mike, take it away.
Thanks, Dan, and good afternoon. Good afternoon for those of you who are in Vermont. So really always a pleasure to be here with you, and I'm going to bring up these slides if I can do that. And I'm going to move relatively quickly so we have time for your questions and also time to hear from Lawrence, of course. So as you recall, there are three primary pools that are offered to fund holders at the Community Foundation. There's a long-term pool, which is a diversified combination of active and passive strategies with a tilt towards active and value-oriented management. I'll come back to that in a minute. There's a socially responsible pool, which is more mission aligned in terms of what it holds. I believe it's now the largest of the pools here, which is exciting, and it's a fabulous pool. It's more heavily passively managed, and it also has a little bit more of a growth tilt, and so that's one of the reasons it's done so much better, particularly of late, than the long-term pool, though it's interesting that they both have the same return for 15 years, which is fascinating to me. And then there's a midterm pool, which is a more defensive pool. It's for shorter philanthropic time horizons. It's 100% indexed, and it uses a lot more bonds is the way that comes through in the strategy itself. So as you can see at the top, the long-term pool is continuing to generate decent, depending on what time period you look at, or good absolute returns. Some of them are a little subpar, like the 0.5% for 3 years. And that is really because the pool continues to suffer under the weight of, again, being more value-oriented, being more diversified. We're going to talk about the index a little bit later because it's kind of an we're living in such an interesting time, and I have a few comments to share with you about that. And it's not that we have the answers, but it raises a lot of interesting questions. And Dan so articulately described the responsibility that exists to protect this capital and grow this capital. And we think this is one of those particularly challenging times to decide how you're going to go about doing that. And that's something we're very focused on. I will say it's a little premature, but we've been really excited about what's been happening in the third quarter so far. There's been some specific portfolio events, particularly the long-term pool, that have been massive value creators that are not in these numbers yet. And so we actually, believe it or not, the one-year number is no longer behind the index as we sit here today, although I don't have those numbers on the screen. So right, as of June 30, we were behind the index. We stand by that, of course. But one of the things I'm going to come back to later is this pool's resilience and its ability to look different at different points in time. And this is not a particularly good one for the pool, as you can see here, at least the long-term pool. But the socially responsible pool, again, it's been carrying its weight quite nicely. So one of the things we talked about a lot here is that we're here to try to generate both strong short and long-term outcomes. Sometimes you do have to make a choice, though. We think this is one of those times where if you have the really strong short-term outcomes, you can still translate those into very good long-term ones. We think that's hard to do today because it requires that you do some leaps of faith in terms of how the markets are behaving and how we think they will behave going forward. So what we think about a lot is the power of compounding. So these are the exact same numbers that you just saw for the long-term pool a minute ago, and with a significant difference. The ones before were per year, and these are cumulative, i.e. compounded. And so it's interesting to think about on a page like this, 7, 8, 8, 5, et cetera, all look like the same outcome. But when you look at it this way, they're very different outcomes. And here you can see the shortfalls that I've just referred to before for the long-term pool, which now do stretch out to a decade. Most of it's happened in the last 3 or 4 years, to be clear. But that still gives us only a 75.7% return when the benchmark was up 86. But then you get to 15 years, and you can see a pretty decent but not extraordinary premium to the benchmark return. And then since we were started here at the foundation so many years ago, portfolios generated 370%. This is net of investment management fees versus 290 for the benchmark. So we're very happy, by the way. We're never happy to underperform. But if someone said to me, hey, you're going to underperform for 5 years, but in exchange for that, you're going to outperform by massive margins over 20 years. Again, we don't love the choice, but we would take that. That's a good trade-off as far as we're concerned. Which gets us to the best way to look at performance, which is to pretend for a second that June 30th, 2024, which is everything I just showed you, is not a particularly special moment in time, i.e. it's no more important than March was or December was or next December will be or the year after that or the year after that. And that's really one of the great flaws of performance comparisons is that we look at returns and we say, did we do well? Did we not do well? But the problem with that, which is fair, is that we're just looking now. And what if it changes for better or for worse, of course? So we tried to deal with this problem, which is that this call happens 4 times a year, which is fabulous. But none of us probably remember what the call was 2 quarters ago and what it looked like. I'm not sure I remember. And we certainly don't know what it looked like 2 quarters from now, 3 quarters from now. So what we do is we say, let's pretend that this group got together literally every month from, in this case, the socially responsible pool started in its current form in 2010. And we looked at every single performance report from 2013 to use the math below to now. And let's just pretend we got to sit down that many times together, which would be fabulous for me. I'm not sure you guys would enjoy my company that much. But if you look at that, we then say, well, what percentage of the time did the pool outperform its benchmark? And how many of those meetings essentially would we have been happy versus not so happy? So that's the batting average. It is still baseball season. And so these are, as you would guess, so just to be clear, the batting average that you don't want to have is 50% here. So it's still a lot better than a great hitter in baseball, but you want to be above 50 for sure. In fact, you want to be materially above 50. And so for the socially responsible pool, which is doing well right now, you can see it's outperformed 2 out of 3 times. So again, if we had met however many hundreds of times this time period covers, we would have sat there and looked at a 3-year number where the portfolio outperformed its benchmark 2 out of 3 times. And if you go across the page, you can see that we get out to 10 years, it would have outperformed basically 9 out of 10 times. So right now, I just showed you one of the 10 times where it's underperformed. So the question that you're going to have to consider is the 1 out of 10 I'm looking at now particularly significant, i.e. does it suggest, this is the long-term pool, not the social pool, by the way, does it suggest that the portfolio is unsuccessful or is it just an anomaly? This data suggests it's an anomaly. This is the social pool. We'll show the long-term in a second. The second question we ask ourselves is how much are you outperforming by? And again, this is another version of the chart I just showed you a minute ago for the long-term pool, where we look at the cumulative. So these are not per year, these numbers, but essentially what this is saying is the socially responsible pool cumulatively, on average, outperformed its benchmark by 6.4%. So you can divide that by 10 if you want to oversimplify it a little bit, but 0.6% per year. So we like seeing that there's a material level of outperformance in exchange for taking on the risk of underperforming sometimes. And that gets you to the last 2 lines, which is the very best 10-year return the pool had compared to its benchmark was about a 10% premium. And the worst was negative 4.8. Again, divide those by 10 if you want to get to something that's per year. And it's really that to us, even though the 3-year doesn't show that, but the other periods do, we like to see positive skew because one of the things that you don't want to have happen is have it feel like a coin toss. Well, if I do well, I do this. If I do badly, I do the same. That's definitely not a good outcome, particularly because the concept here is that you'll make some mistakes in the short term. You'll have short-term underperformance, but that the winners will more than outweigh those. And that's what that skew at the bottom basically shows you. So let's look at the exact same statistics for the long-term pool, which has been here a little longer. So we go back to 2002 here. And these are actually they might be surprised because I just showed you earlier how the socially responsible pool has done so well, which it has, by the way. These numbers are even stronger for the long-term pool, despite the current data point being disappointing. And for example, going back to a minute ago, you saw that the long-term pool has underperformed for 10 years. But that's actually a very relatively rare occurrence. It's only happened 6 of the last 100 10-year periods. That's the 94%, 93.9% ratio you see. You could also see, you might have heard me earlier say, well, the socially responsible pool is more passively managed, which has been quite beneficial. And so you might say, well, maybe passive is better, and the long-term pool has a liability related to its active management. The median outcome suggests it has not been a liability. So the median level of outperformance is 30 percentage points. Again, that's not per year, divided by 10, though. So a lot of outperformance, and that does include the underperforming periods. Of course, it doesn't exclude anything. And then the skew here is particularly impressive, particularly over 10 years, where the best case scenario was a 39% level of outperformance, and the worst case is only negative 3.8. So again, these are the kinds of statistics that I hope give you some confidence when I make bold statements like, be careful how you interpret this one data point, i.e. the June numbers that we're looking at earlier. And we've looked at a few others like that have been disappointing as well. So it's not a unheard of thing to have disappointing outcomes, but put in the context of this 22-year track record, you can see the returns have actually been extremely strong, and we're very proud of those, as you would guess. So how's it done? Briefly, 3 simple rules, and we'll be talking about the markets in a second. And this is a challenging time to be a long-term investor, despite what you might think. The first thing is we think long-term. The second thing, and I'm sure there'll be questions we do these presentations for some of our other community foundations. People generally want to hear about presidential elections and other events going on in the world and what their impact will be. And if you read the second bullet point, you'll get a good sense of what our answer will be, which is we have no idea. We have of course, like everybody, have opinions about what we'd like to see happen, wouldn't like to see happen, but we have no idea what will actually happen, nor do we have an idea of what the implication for markets will be per se. So we don't try. It's a really important part of the strategy. But what we do believe in very strongly is the power of diversification. It's the only free lunch in investing. And it's something that investors today are ignoring, which makes me nervous, to be clear. Here are the different mixes of the 3 pools we talked about. And you can see that the long-term and socially responsible pool are very similar in the sense that they are geared towards high long-term outcomes. They're geared towards sustaining and enhancing impact of your funds and others in the state of Vermont. And so they're very heavily tilted towards high returning classes like stocks, which is what you can see in that first 6 lines or so. Special opportunities, just as a reminder for those of you who have been on these calls before, these are mostly concentrated, very idiosyncratic kind of esoteric strategies. They're very focused in specific areas like life sciences or other things. And they're very high octane strategies. And we card them off separately because they're not as diversified as other strategies. But you can see 60 to 64%, if I look at the first 2, the socially responsible and long-term pool in stocks, only about 20%, give or take, in bonds. And then the balance, in alternative investments is what you can see here. The committee reviews this mix at least once a year, doesn't change it every year. We do react to things like higher yields that can lead to wanting more bonds, for example, but those are all based on long-term thinking and long-term concepts. The midterm pool I mentioned is for a shorter horizon. And if you're going to shorten an investment horizon, you need to make sure the portfolio by definition is more defensive, because what you don't want to have in a portfolio or a fund that might distribute 20, 30, 40% of its capital in any given year, depending on need and depending on the desire of the fund holder. You can't have that happen, for example, when the stock market's crashing. It creates permanent damage to the value of those dollars. And so what we do is we hold less in stocks in this pool just to reflect the idea of having less risk in the portfolio. And we accept there'll be less return, which is the way it should work, basically. So I'm going to quickly go through this and get to the markets. So manager selection, actually, even in the long-term pool, despite what you see currently, has been very strong. There are 4 basic rules we follow, which is that returns are always accompanied by risk. We have to know the people, know the key personnel very, very well, and we don't like complexity. Third place, which is Barry and his team, operational issues. We have a dedicated team at Crucial that makes sure that everybody's operationally sound. We cannot have any Bernie Madoff risks. You don't get paid to take operational risk in a portfolio. And there's a lot of different elements that go well before fraud. Essentially, there's just a lot of really unhealthy structures out there that are marketed as investor friendly, but they're actually very unfriendly when bad things start happening. But the last point, this is where I think and I realize Dan called out some of the members, and I'm sorry to compliment them while they're sitting here and not do it right in front of them. But having a really thoughtful investment committee is one of the most incredible assets, I think, that I personally have interacted with at the Community Foundation, because they understand this last point and then some, which is it's a forward-looking process. If investing was always about, hey, what did well? Let me do that. It would be a lot easier than it actually is. It's a much harder problem, and that's what the investment committee here is just unbelievable about. And it's been nice to have them as someone we could partner with for all these years. I'll skip by this. This is just all the many things that go into magic due diligence. And let's switch to this. So a lot of people, rightfully so, would say, isn't it interesting that the world is as messy and complicated as it is today? And I'm not even sure they're thinking about all the things that we think make it messy and complicated. We're more narrow in terms of thinking about capital markets, and I'll talk about that in a second. Isn't it interesting that that's happening, and the stock market just blithely keeps rising for the most part without any concerns in the world? And what does that make sense? And the answer is no, it actually doesn't make sense. And the reason it's so interesting is because the stock market actually is not really rising all that much. 7 or 10 stocks are rising a lot, and everything else is kind of being left behind, which we see as both a problem because we're competing with a benchmark that has more and more of those 7 or 10 stocks in them. That's what you saw earlier for the long-term pool, and also an opportunity. So it's very interesting. But let me just carve out for you some of the things that make this world as risky as it is. It's actually, I think this might be one of the riskiest economic and market climates I have seen in at least since prior to the global financial crisis, the great financial crisis. And it starts at the top, which is inflation is back. I know you all see this in your daily lives. And yes, the CPI numbers are coming down, but they're not going back down to 1 or 2%. They're going to stay higher. We live in a multipolar world today, and I don't think we're going back to a world where everybody wants to trade with each other and keep inflation at bay. This is a very different world than the world we've been in, and it's inflationary. And some of it's good, by the way. By the way, having labor get a bigger share of the economy isn't a bad thing, but it can be inflationary. Having a multipolar world is inflationary. And so inflation being more normal today, let's call it that, and not depressed as it has been since most of the time since 2008, is important because what it does is it increases interest rates. And that's what you see in your savings accounts. You're finally not being punished to be a saver. You can see all kinds of things. And think about this concept of competition for capital. Because you're getting paid 5% right now to own cash, basically, you should be asking yourself the question, well, how much more do I need to make to take risk? Like, what should I buy the S&P 500? How much higher will its return be than my cash account? And if the answer is not much, which is what I'm going to show you later, then why would you own the S&P when you can own cash? And that's not really the way it works at the foundation, because we need to earn CPI plus 5%, so we can't accept 5% for a lot of the assets here. But the reality is that competition for capital is a really important factor and an important force to consider. And it creates the second point, which is that when you're not being forced as an individual or a foundation to put your money at risk because you're not getting paid anything for it, it creates scarcity. And that leads to more bankruptcies. That leads to a more normal business cycle. So I feel like I'm on the doom and gloom tour today, and I apologize for that. But if you're in a world where the Federal Reserve is not manipulating the bond market anymore, that creates very different funding climate for companies. And we've seen the way that's played out in terms of some of the technology companies that have crashed since 2021, the smaller ones. And that's because of the funding climate being different. The market actually reacted quite rationally to that. Where it has not reacted rationally is the last point, which is the S&P 500 is an interesting version of itself today. We'll put it that way. So for those who don't think about indexes all day, the S&P 500 has 500 companies in it, as you would guess. And over those 500 companies, each company's weight in the index is based on its size. And size in this case refers to what we call market capitalization. Market capitalization is the number of shares times the price. So if a company has whatever number of shares it has and the price goes up a lot, it gets bigger. It's that simple. If the price falls a lot, it gets smaller. So very simple. So what this chart is showing you is going back to 1990, take the biggest 10 names. How big were they as a percentage of the index? Very simple. And the average, I didn't really count the average, but it looks like it's about 20% or so. So the 26.7 that you see on the left there, that's the last asset bubble we had in the United States for the S&P 500. I use that word bubble and last purposely. And let's come back to that in a second. The current number, which is really June 30th, is 37.5%. So top 10 names are 37.5% of the index, which is a much larger percentage than they were back in 2000. So one of the fascinating things about this, and this is a very, I think, interesting example to illustrate how much different things are today and how they are also the same. So back in 2000, the biggest company, I believe it was the biggest company in the world, but one of the biggest companies in the world was Cisco Systems, which, if you recall, is still, by the way, a pretty important hardware provider. And back then, there was a lot of enthusiasm about this thing called the internet, and that Cisco owned that market. We're going to apply all this hardware for the internet. And that makes sense. The problem is, though, that Cisco got to be valued, it was so optimistically viewed by the markets that it got to 5% of the size of the US economy at the time. So think about that for a second. So one company, according to the stock market, was worth 5% of the size of our entire economy. Fast forward to today, asset bubbles always burst. There's just no way to get around that. They don't burst when you want them to. They don't burst on any schedule, but they do burst. And Cisco's stock today, if you were unfortunate enough to think it was a great idea in 2000, is still 37% lower than it was then. And that's not relative to an index. That's a loss of 37% of your capital over 24 years. So today's parallel, you know what's coming next, I'm sure, is NVIDIA. NVIDIA is a dominant market-leading provider, as we all know, to this new and very important thing called, the artificial intelligence, generative AI. This is a big deal, and just like the internet was a big deal, generative AI is a big deal. We're not debating whether it's important or not important. And here's the problem: NVIDIA at its peak wasn't 5% of US GDP; it got to almost 12% of US GDP. And I say that because a lot of people in NVIDIA are very happy with their ownership in NVIDIA, and I actually applaud them for being smart enough to own NVIDIA and own a lot of it. But there is a point where stock gets so high that you do suffer the Cisco flaw, which is that it just cannot support, reality doesn't support that price. And again, I don't think it's actually debatable whether any company, NVIDIA or otherwise, is worth 12% of the size of our economy. I'm sorry, that's insanity. So we'll keep moving. Here's a list of some of the great names of the past. And again, you'll see some of them hang around a long time, by the way. It's really interesting to think about that. But the fact is that NVIDIA, like everybody else, will have its day in the sun and then its day in the clouds. It's just how things work. Technology is a very dynamic industry. If something is so profitable that you should be worth 12% of US GDP, trust me, other companies are coming to compete with you, and they will eventually catch up to you and if not surpass you. That's just the way the world works. Not to pick on a New York company, but I mean, companies like Kodak had the world as their oyster years ago, and look at them today. And that's just what happens eventually. This is the cycles of company lives. And these companies are all still around for the most part, by the way. So one more thing on the markets that I think I want to leave you with, which is something we've talked about before, which is that investing fascinates me for many levels. I've spent my whole life in it. And one of the things that fascinates me is it's the only part of our lives where we like to pay more for things. I don't know about you, but I don't walk in the supermarket and see a loaf of bread selling for $3.50 and say, I'm going to give you 10 for that, because it's insane. Why would I do that, right? Well, in the stock market, people love to pay more for things. And just like the loaf of bread, I mean, if I have obviously I have a limited amount of funds. If I start wasting my money on bread more than I need to pay for it, I just won't have as many things as I would have otherwise had. And in the stock market, it's the exact same thing. If you pay too much for things, you do have less at the end of the day. You don't feel that way, but that's how you should feel. So what this table is showing you is it's taking the work of a wonderful economist named Bob Shiller, who's a Yale professor, and he came up with this, simple and elegant solution to how should we think about what the value is of a company, in this case, an index, which is let's get away from the cyclicality of earnings and economies and all these things and just do a 10-year average. So he averages the 10 years of earnings adjusted for inflation for the S&P 500 because of the ratio. It's that simple. And that's this price earnings ratio, the E again, 10-year average of earnings, inflation adjusted. Then all he did is he put them on his website. So, okay, here they are back to, I think it's like to 1880. So we took every single, this is the tables of crucial creation. We took every single data point, month-end data point he had. And we said, let's just put it in a bucket. So you can see at the very bottom, 226 times, the Shiller ratio is between 4.8 and 10. Up to the top. So right now, I believe it's just around 35 and a half today, the Shiller ratio. So it's in that gray or beige shaded line to the second from the bottom, from the top. That's where the Shiller ratio is today, which, by the way, has only happened 34 times in history. That should concern you right there. It's a rare event. And back to the foundation for a second, we really are very concerned with the fact that there are no do-overs at the foundation. If we mess this up and we lose 35% of the capital, for example, over the next 10 years in a stock like Cisco, we don't get a chance to go back and undo that decision. That has a permanent negative impact on the foundation. It's an irrecoverable mistake. So we think about that because history teaches us things about what happens in asset bubbles and happens in optimistic markets. And so now that's what gets us to this last point. So each of these buckets, you can see to the left, the number of times it was in that bucket. Go to the far right now. What we did is we said, well, let's see is there actually a relationship here? Does it matter what the Shiller ratio is? And so we did. We said, let's just measure the next 10-year return. So every single month, we said, what happened next for 10 years? That's it. Nothing more complicated than that. And then we showed you over the right, the median returns for those next 10 years. So again, median is the middle of the distribution. Half were better, half were worse. And guess what? Back to my bread loaves. This is exactly what it should look like, which is that if you were as excited as people were, by the way, when the Shiller ratio was above 40, your average return for the next 10 years, including dividends, was negative, and not relative to something, just negative. In the current box that we're in right now, if history is a guide, you'll earn about 2.5% per year for the next 10 years in the S&P 500. Pretty sure most investors don't think that's what they're going to get. And where we started, if you want to be an optimist, and that's good with me, I generally like to be one too, despite what you're hearing today. The best historical outcome when a Shiller ratio was as high as it is today was basically less than we can get on a T-bill right now. And that's competition for capital. And I think one of the things we'd say is with your personal capital, of course, you have every right to do whatever you want. And the idea that we or anyone know exactly what's going to happen is not true. We do not. But for the foundation's capital, we're very focused on this idea that we cannot afford to earn 3% a year on our stock portfolio for the next 10 years. And that's not a portfolio we're going to own. So we're going to own things that are different, the purpose of which is not to be subject to this. Because yes, mistakes get made in investing because it's looking forward. It has all kinds of risk associated with it. But the mistake we cannot and will not make is to ignore history and pretend this one time will be different. That's a risk. Again, if you don't have a chance to go back and fix it later, you cannot afford to put hundreds of millions of dollars of capital that supports Vermont at risk of this time being different. I'm going to jump by this and just point out that a couple things. Again, I'll use the NVIDIA point one more time, 12% US GDP. I can't even imagine how that could happen. Second point, being safer, being more diversified, being concerned about what happens next is actually starting to pay off. I'm looking forward to having a few more calls with you guys in the future where you see different outcomes than you saw today for the long-term pool. And we continue to try to capitalize on these extremes. There's a lot of exciting things happening in the portfolio, mainly because the managers and the committee look at bad news and say, is it an overreaction? And maybe there's places that we can add a lot of value by just potentially being long-term and patient, which is our strategy at the end of the day. Be patient, do things where we have a high probability of success. Again, betting that history is wrong does not have a high probability of success. Staying diversified, thinking about the quality of what you own and what you're paying for it, those are repeatable advantages that time does fix. If you're not, even if you're having a short-term issues. At the end of the day, despite all the doom and gloom, I'm not saying we're looking forward to a major credit crisis or a major retrenchment in the economy. We would never say that, but we do know that it's going to happen. And when that happens, volatility has always been the foundation's friend as investors go. So I'm going to stop there, and I think I'm going to hand it to Lawrence. Is that the order of operations here, Dan, or questions first?
That's right. Thanks, Mike. I am just going to ask folks to hold questions and ask Lawrence to provide an update on the Vermont portfolio and give us about 10 minutes and then open it up for questions. But if that works. Thanks, Lawrence. Thanks, Mike.
Thank you. I'm adjusting my screen to make sure I understand what part is actually being seen. So with the Vermont portfolio, this is an area where, these are largely illiquid investments. We tend to make them for long-term for the most part. So we don't do adjustments on the valuations from quarter to quarter. We look at it once a year unless something major happens. So this presentation is a little bit different. I would say if you think about the goal of a long-term endowment, you sort of think of preserving purchasing power, net of grants, expenses, and inflation. And with the Vermont portfolio, we think about preserving purchasing power, net of losses, expenses, and inflation. So over the long haul, this part of the portfolio has financial returns of around 2.6%. But what we're looking for here is a blend of return. And so we start with looking at any investment, looking for what's the market return that we would like for this, adjusted for risk, a higher return for higher risk, and then adjusted as well for social impact. So when we're well aligned with the opportunity gap impact areas, there's a situation where we are likely to accept a much lower return, financial return, in exchange for the higher social impact return. So I'm going to talk a little bit about one category of these that we find ourselves participating in. And I should preface this by saying most of the Vermont portfolio we invest through intermediaries. So we work with the housing institutions, we work with venture funds like Fresh Tracks, Flexible Capital Fund, and others, and they make individual investments. But we have some stuff where VCF can play a role that no other participant is prepared to play. And so we consider this set of activities are project acceleration loans when there's really a chance that we can make a big difference by our direct participation for a few years in an individual project. So I thought I would highlight 4 of these that we've got going through the pipeline right now to demonstrate. And that's the Plainfield Co-op, which Dan mentioned earlier, the Center for an Agricultural Economy up in Hardwick, the Center for Cartoon Studies in White River Junction, and the Paramount Theater in Rutland. What these have in common is that they've got projects that need to keep moving while they continue to fundraise. In the case of the Plainfield Co-op, they've been there since the early 70s. They've stretched their space, be sort of beyond what's useful for them. They've got, they're in a tough location with the upcoming bridge rehabilitation in Plainfield. And at the same time, the Plainfield Hardware and General Store up on Route 2 came on the market. And that became vulnerable if the community lost that. So the Plainfield Co-op was successful coming to an agreement to buy the Hardware and General Store, to merge and relocate. And they'll sort of, using the same model that we saw with City Market, sort of expand the co-op offerings to include the conventional offerings and serve the entire community out of the new facility. In this case, the lead funders are the Cooperative Fund of the Northeast. We happen to be an investor in the Cooperative Fund of the Northeast. So part of our due diligence was talking to them, with whom we have a very good relationship. And they also have backing from VITA. The condition here is that they needed to raise about $500,000 from members. And that's a significant amount of money in a community like Plainfield. Their fundraising went extremely well, but some of the pledges, some of the commitments from members were in the form of pledges that'll take a couple of years to fulfill. And given that the flood happened in July right before they closed, their fundraising stumbled a little at the end with really critical needs, other needs in the community. So we provided some gap financing, about $75,000 that they can use for a couple of years while they complete their fundraising, but keep the move on time and get that integration done. The Center for an Agricultural Economy is another relationship. We've had a long-term grantee relationship with the Center for an Ag Economy. This is a food hub. They operate the Food Venture Center. They have farm to school activities. They've got a real range of stuff, and they're a real anchor for the Hardwick food economy. They're fitting up a space that they're going to be leasing in the Yellow Barn Innovation Center. We provided some capital in a similar way to help the construction of Yellow Barn Accelerator. But what happened is costs went up through the project, and some of the fit up that was originally in the construction budget for the landlord shifted to the tenants. So this increased CAE's fundraising objectives meaningfully. And they also elected to pursue a net zero approach, which also increased cost. So in order to get in this space this year and start using it and have all of the advantages of the improved space, they needed some bridge financing in anticipation of grants and donations that'll come later. So again, it'll sit in there for a couple of years while they finish their fundraising. They'll be in and productive in the next couple of months. And after a couple of years, we'll go on and help somebody else. The Center for Cartoon Studies started about 20 years ago in White River Junction and has become a significant anchor institution. They have rehabilitated a bunch of leased spaces scattered around White River Junction. And they have the opportunity to buy the old Telegraph building, which happens to be a light brownfield remediation project. This will give them 3 nearby significant spaces that they can use and really open up some of the spaces that they currently lease for others for other development in town. So I'm thinking that that's also a couple of year type of relationship. And that we're just waiting for the corrective action plan. And finally, the example of the Paramount Theater. Paramount Theater acquired both the theater and the adjoining Richardson block years ago. I mean, this is 20 some odd years of success. They're going to rehabilitate the Richardson block to really expand the number of guest spaces, improve spaces for performers, have a lot of space for additional community events. It's a big project. They've got a great balance sheet. They came through the pandemic really well. They're putting on more performances with more seat occupancy every year. Just a great success story in Rutland. So again, we'll be in there for a couple of years while they're able to finish construction and get the pledges that they've got to come in. So that's my presentation, and I will stop sharing and we'll open it up for questions for Mike or I.
Great. Thanks, Lawrence. Questions from folks on the call? I appreciate. I'm always willing to dive in and monologue a little bit. But Lawrence, you outlined those 4 projects. I think one of the things I would take away as fund holders relative to the Vermont portfolio is you look a lot like as you look across the country and in Vermont right now, one of the important narratives that people are focusing on is the conditions of rural communities. And as our mission as an organization and a constellation of funders and fund holders is around community vitality, for us to be able to be reinvesting in communities with philanthropic resources for impact, I think is both an important story to tell, but it's also a point of innovation. We've been doing it this way with an asset allocation for more than 20 years. And increasingly, we're seeing a lot of other community foundations looking for our insight around best practices and the approaches we've cultivated. So I think there's a lot to be proud of as a part of the VCF for the role that philanthropic assets are playing in revitalizing some of our small places. Questions? Really? We stumped it?
No, quiet group today.
I'm not gonna go back to law school and start cold calling people. For those who are unfamiliar with our sort of governance approach, this is the public call. In a week or two, we will have a deeper dive over course of a couple hours with the investment committee and go through a longer crucial report on performance and look at individual managers, led by Tim Briglin as chair of that committee. So there's ongoing and deeper discussion around the performances of the portfolios as part of our fiduciary and practical objectives. So no questions. Mike, since I texted both of you and said keep it tight, is there anything you would have touched on that you didn't touch on because I wanted to leave room for questions?
No, I said my piece. I think everyone's busy selling their video stock. That's why they had. I'm joking, of course. But no, I have nothing I would add.
I would just add that, one of the things that I get out of working with these organizations and businesses that are looking for the type of gap financing that we're providing in the examples I mentioned is in each of those cases, the board and the senior leadership at the organization are really working tightly together and doing great work in their communities. And that's part of our due diligence, is understanding that these really are robust organizations. And that's what gives us the most confidence that we should be playing a role there. And so it helps when we've got a long-standing grantee relationship, as we do with CAE. But in other cases, we're able to really have experience with individual board members or officers and really gain comfort around the likelihood that they'll be able to accomplish their goals, because in many cases, these are sort of like the old-fashioned character lending, and it's the character of the organization that we're looking towards. It's just a real privilege to get to know some of these Vermonters who are doing this work in those communities.
Thanks, Lawrence. I am gonna, take the liberty, if there aren't questions coming, I won't be offended if I start seeing people drop off, but I'm gonna take the liberty of correcting a couple of data points that I shared about flood response. Since we did just go out with a press release, and I was gently corrected in a side chat. We've actually, since July 10th this summer, we raised an additional $850,000 into our flood fund. We've already granted out more than $500,000, which brings our flood response total grant making to about 13.7 since July 10th of 2023. So just as an engine for recovery and response of flood affected communities, the Community Foundation, I think your partners here have done just an incredible job. To broaden the context a little bit, we've seen an early and generous amount of grant making this year. Last year, we did $44 million worth of total grant making from all donor advised funds, distributions from reserve funds. And then through June 30th of this year, we've actually done $31 million. So that is an 18-month total of $75 million worth of grant making from all funds across the VCF. So I share that because it's important. We get into the impact of those grants and the projects they're funding and the things that they're doing, and they're diverse and they're multifaceted and frequently intersectional across communities. But just from an engine of non-governmental leadership in communities, that this organization is putting a lot of resources. And so when we think about the performance of our funds, and the farthest right column that Mike focuses on in terms of the long-term value, we've grown a lot as an organization in terms of assets under management, but even more importantly, the cumulative cumulative amount of dollars grant making has grown even more dramatically. So we're about $400 million under management, give or take, given the month or here or there. But we've done more than $465 million of grants in the course of our lifetime, which means since 1986, when we were founded, our average grant making is about 12.2. In the last few years, it's been $44, $48 million a year. So that's obviously growing. But again, the role of an organization like ours that you all are a part of, or considering being a part of, or partnering with, or on the board of, or staff of, in this practice of making a gift to open a fund, seeing that fund grow, and then making grants over time is about cumulative impact and changing the trajectory of communities. And that growth piece is what we count on, Mike, and crucial in the stewardship of the investment committee to generate. So your partnership is what makes it possible. And I'm grateful there are folks on the call who supported the flood fund and supported the VCF directly. And but your work with us makes it possible. So thank you. I'll pause and see if I have created space for somebody to think of a question. All right. If nobody's coming off mute to ask the question, our team is very available to field direct questions one-on-one. Stacy Fagan, VP for Philanthropy, is on the phone, as are a number of our philanthropic advisors, Emily Pilo Corbett, Ruth Henry. I'm not sure I'm missing who else. Feel free to reach out for more direct questions if you have them about our portfolio management, about our strategies, and Lawrence or I are for more direct questions about the role of the Vermont Mission Investment Portfolio. If you're interested in our theory of change that informs our decision making associated with that. But we are eminently available, and we are deeply grateful for your partnership.